is market breadth. Market breadth indicators analyze the number of stocks advancing relative to those that are declining in a given index or stock exchange, such as the New York Stock Exchange, NYSE, or Nasdaq. Positive market breadth occurs when more stocks are advancing than are declining. This suggests that the bulls are in control of the market's momentum and helps confirm a price in the index. Conversely, a disproportional number of declining securities is used to confirm bearish momentum and a downside move in the stock index. Certain breadth indicators also incorporate volume. They will not only at whether a stock is advancing or declining in a price, but also at the volume of those moves. This is because price moves on larger volumes are considered to be more significant than price moves on lower volume. Some key takeaways. Market breadth looks at the relative change of advancing to declining securities in a market. Market breadth indicators may forewarn of reversals and uncover strength or weaknesses in the movements of an index that are not visible simply by looking at a chart of the index. This occurs when the indicators diverges from the index. Indicators may look at advanced decline stocks volume, the number of stocks reaching certain hurdles, and other metrics. Understanding market breadth. Market breadth refers to how many stocks are participating in a given move in an index or on a stock exchange. An index may be rising, yet more than half the stocks in the index are falling because a small number of stocks have such a large gains that they drag the whole index higher. Market breadth indicators can reveal this and warn traders that most stocks are not actually performing well, even though the rising index makes it look like most stocks are doing well. An index is an average of the stocks in it. Volume may also be added into these indicator calculations to provide additional insights into how stocks within an index are acting overall. Market breadth attempts to find out how much underlying strength or weakness there is in a given stock index by accessing the strength or weaknesses which isn't plainly visible. By looking at chart of the index, technical indicators gain insight into what index may do next. A large number of advancing stocks is a sign of a bullish market sentiment and is used to confirm a broad market uptrend. A large number of declining stocks shows a sentiment is bearish, which would align with an index downtrend. When measuring market breadth, many indicators look at the number of advancing and declining stocks or numbers of stocks that have created a recent 52-week high or low. This data can be provided information about whether an index uptrend or downtrend is likely to continue. Market breadth indicators and uses. There are a number of market breadth indicators. Each is calculated differently and therefore may provide slightly different information. Some indicators look at the number of advancing or declining stocks. Others compare stock prices to another benchmark, and few incorporate volume. The tactic for most market breadth indicator is to monitor for confirmation and divergence. Confirmation is when the indicator is moving favorably and the index is rising. Divergence is when the index and indicator move in opposite directions. This warns that the index may see a reversal soon. Here is a sampling of the market breadth indicators available. Advanced decline line index. This indicator, known as AD line, calculates a running total of the difference between the number of advancing and declining stocks. Traders typically look for divergences between the indicator and a major market index such as the Standard & Poor's Index 500 Index, S&P 500. For example, if the S&P is rising and the AD line is falling, it indicates the current uptrend in the index may be losing its momentum. On the other hand, if the S&P 500 is falling and the AD line rising, it suggests that the move lower in the index may be about to reverse. New highs low index. The new high-low indicator compares stocks making 52-week highs to stocks making 52-week lows. A reading below 50% indicates that more stocks are reaching their lows compared to stocks that are reaching their highs, and could signal a move into a bear market. Contrarian investors may use this market breadth indicator to buy or sell stocks when it gives extreme readings, such as below 30% or above 70%. S&P 500 200-day index. Traders can use this index to see what percentage of stocks in the S&P 500 are trading above their 200-day moving average. A rising indicator above 50% indicates broad market strength. Similarly to new highs-lows index, traders often look for extreme readings to find overbought and oversold conditions in the broader market. Short-term traders who want a more sensitive moving average to provide earlier sign can use a 50-day index that shows what percentage of stocks are trading above their 50-day moving average. Cumulative index. This indicator measures volume. Stocks that rise have their volume added to the positive volume. Stocks that decline have negative volume. The indicator keeps a running total of whether the overall volume is positive or negative and by how much, and is used in a similar fashion to the AD line. Unbalanced volume. This indicator also looks at volume, except up or down volume is based on whether the index rises or falls. If the index falls, the total volume is counted as negative. If the index rises, the total volume is negative. Each day is added or subtracted from prior readings to give a running total. It is used in a similar way to the AD line. Market breadth indicators are a very important piece in your trading system. I use many market breadth indicators to give me a weight of evidence to which direction this macro market is going. I can also break it down to the sectors and individual securities. Please study many market breadth indicators. You know the catchphrase: study it, analyze it, adapt it. Peace.